So customers are happy, shareholders are bleeding, and regulators are having a headache. And welcome to China's food delivery war. So specifically in this video, we are going to investigate the relationship between these three parties and more importantly, the three companies that are involved in this involution. And as always, I put my biases up front and I do have a total of roughly $75,000 invested in two out of these three companies that are involved in this space today. Namely Alibaba, which is my largest position, and Meituan, which is my fourth largest position. And as I've alluded as I started the video, these three companies, namely Alibaba, Meituan, and JD, has severely underperformed since March of this year. And when compared to the Hang Seng Tech Index, which is denoted in green, and all three of them has experienced significant share price declines in the last 3 months. So what exactly is going on in this quote-unquote delivery war? And I do agree wholeheartedly that a picture speaks 1,000 words. And these are just two of the thousands of pictures that are going viral, whether is it on mainstream or social media platforms like Xiaohongshu or even Weibo. The Chinese people today are stocking up beverages like they are preparing for war. So let's talk about them. But before that, I also would like to declare a war on the like button, because I do realize that if I don't flag it out, many of you forget to tap on the like button. So please do me the favor and tap the like button before we proceed. Now, let's talk about how people are describing this current state of affairs. So Alibaba's food delivery strategy has distracted investors away from the DeepSeek-led AI boom that drove its shares up more than 80% in just 2 months earlier this year. So the company has merged its delivery unit into its core business and boosted subsidies since JD.com's former entry into the space in Feb. So it's a costly fight. Nomura Holdings estimates about $4 billion has been burnt on discounts in the June quarter alone by the three companies combined. And the sector leader, Meituan, said on Saturday that it was going into attack mode versus Alibaba. So the company's extreme moves have drawn much criticisms from the government over the potential disastrous impact to the industry. And the end result? Alibaba might sustain a loss of 41 billion yuan or $5.7 billion in its food delivery business. And the consensus estimates for Alibaba's 12-month forward earnings per share is also down 6%. And with all that said, analysts still feel overwhelmingly bullish with 44 buy ratings on the Hong Kong shares with no holds or sell recommendations. So in terms of upside risks, some analysts note that the government may step in to curb price competition if the market takes a heavy blow and margins get squeezed further. But investors may remain cautious until a definitive end to the steep discounts. And I quote, "We do need to watch for price competition that evolves into a situation where certain companies decide to gain market share at the expense of profitability," unquote. But here's the thing, I'm going to show you two news headlines and you tell me whether these companies have already forgo any idea of profitability. From CNA, 0 yuan milk tea. I repeat, 0 yuan milk tea, basically free of charge. China's food delivery price war hits fever pitch. Another headline from CNBC, China's instant commerce price war sees 30 cents drinks and billions of subsidies doled out. Let me ask you, do you have $2,000 just sitting in a savings account doing nothing? Right now, Longbridge, an MES licensed broker in Singapore, is running a generous new user promotion until the end of July. And if you sign up using my link below and just deposit $2,000, here's what you get. A 6 plus 6% per annum interest boost on your first $2,000 for 90 days, exclusively through my link. And that's $60 in interest if you park the cash in their Cash Plus product. On top of that, you get an additional $18 cash coupon just for signing up and depositing. And if you hold your funds for 30 days and complete 3 buy trades, you'll receive half an Nvidia share worth about roughly 100 Singapore dollars today. And add that up and you are looking at around $178 in value on a $2,000 deposit. And that's 8.9% before you even start investing. So you also enjoy lifetime commission-free trading for US, Hong Kong and Singapore stocks. 0 platform fees, and if you've got more capital, rewards can go up to $800 in total just for getting started. So don't miss this out. Click on the link in the description below to grab your exclusive rewards. And thanks to Longbridge for sponsoring this video. So I fed to GPT this news article, and this was essentially the summary. So JD.com kickstarted the war by offering 0% commissions to restaurants and launching a 10 billion yuan subsidy program. Not to be outdone, Alibaba also announced a massive 50 billion yuan subsidy package in July, while Meituan actually slashed prices with discounts like 0 yuan milk tea and $2 yuan coffee. And on Saturday alone, Meituan actually received 120 million orders, mostly from food, and Taobao plus Ele.me clocked in 80 million plus orders with 13 millions in non-food. And despite the consumer buzz, the price war is weighing heavily on earnings and stock prices. I'm so surprised that happened. And in fact, the China's market regulators summoned all three firms in May, warning them to compete fairly and to avoid anti-competitive practices. And here's two screen grabs from the latest presentation from TechBuzz China to let you have an appreciation in terms of the booming of this entire industry, for better or for worse. So at early 2025, you only have two main players, which is Meituan in yellow and Ele.me or Taobao in blue, which is owned by the parent company Alibaba. So Meituan was delivering roughly 70 million daily orders, while Taobao or Ele.me was doing 30 million. And as of July 5th, Meituan ballooned to over 120 million daily orders, Taobao Ele.me went to roughly 80 million, and JD clocked in roughly 20 million. And in terms of the breakdown of the type of orders, overwhelmingly, most of them are related to beverages like bubble teas or coffees. So zooming into the tweet, China's shocking new Singles Day is all about home delivery. So in the afternoon of the 5th, Meituan noticed Alibaba's orders starting to exceed expectations and initiated heavily subsidizing, offering customer discounts. And this is in stark contrast to its relative lack of response to JD's meal delivery activities since Feb. So the two platforms mobilized tens of thousands of employees and hundreds of thousands of merchants and millions of couriers. So by that evening, extra couriers were mobilized by offering a bonus of more than 10 RMB per order. And despite having the largest courier pool, Meituan still couldn't get enough couriers and offered customers more discounts if they picked up their orders, which explains the whole fridge. And by 9 p.m, Meituan has exceeded its own record with 100 million orders. And 2 hours later, it reached 120 million. And Taobao's order reached roughly 80 million. So Alibaba aims to replicate their Super Saturday every week for 100 days. So this is the current state of affairs. And many of you might be wondering, what should investors take away from this? So I've also happened to chance upon this research put out by Dolphin Research recently, and I just wanted to outline a few of the different scenarios that they planned out. But the focus here really is much more on the penetration of JD.com into the food delivery space. To also give you a little bit more color in terms of the breakdown of the type and the volume of the orders. So when comparing Meituan to JD, I think these are considered private data. I'm not too sure how they got it, but let's take it at face value. So the daily order volume for Meituan is roughly at 62 million orders, while JD is at more than 25 million as of June. But let's not forget, these numbers that was extracted from Meituan was at the end of Q4 of 2024. They've already doubled their daily order volume in the span of 6 months. So I'll put the link to the entire research in the description box down below. But do note that the original research text is in Chinese, but I'll do some sort of a summary later on. And if you were to compare Meituan versus JD today, the average order value of Meituan is roughly $45, while for JD, it's roughly $20 to $30. So yeah, I think Meituan as the market leader and as the incumbent, it definitely does enjoy higher levels of advantages, whether it's in terms of size, scale, people's spending habit, and the amount of GMV that they're clocking. In terms of network-wise, Meituan cover more than 2,000 cities, while JD currently covers only 350. And the number of riders, Meituan is at 7,005, and JD is about 1,100. But really, if you to compare to the number of riders versus the daily order volume, is either JD inflated their order volume by a lot, or Meituan is not really effective or efficient in terms of the ratio of riders to order volume. But right now, at least based on the numbers, Meituan is making roughly $1.30 yuan per order, while JD is losing between 8 to 12 yuan per order. Clearly, someone is out for blood because they don't care about profitability and they're just all about gaining market share. So here's a summary of the piece put out by Dolphin Research. So JD.com has recently just crossed the industry-recognized break-even threshold, which is roughly 20 to 30 million daily orders. And if the numbers are accurate, JD riders are handling double the average daily orders of Meituan riders, suggesting operational strain or just inflated figures. So huge subsidies are behind this growth, and they're estimated to be losing roughly $10 to $15 per order, possibly 6 billion yuan in monthly losses at a 20 million daily order run rate. So the natural question is, why focus on beverages? I think there were a few strategic reasons. Firstly, of course, beverages are discretionary and it's easier to stimulate demand via the subsidies program. Secondly, there's higher chain store penetration, enabling them to scale up very effectively in a very short period of time. And lastly, of course, it's easier logistical movements due to the flatter demand curve versus some of these peak meal periods. Any time of the day, you can order beverages. And there's also a few value considerations where beverages in general, they are lower basket sizes, and the price sensitivity do imply lower profit potential post-subsidy. But higher volume actually helps build the dense last mile logistics. And beverage dominance is deliberate and actually tactical because it's used to gain order volume and to optimize fulfillment routes. So then the natural question is, can JD actually win this delivery war? So there are two levels of successes here. I think on tier 1 success, which is pretty achievable, which is to sustain that 20 to 40 million daily orders. And it basically helps funnel traffic to JD's core e-commerce and instant retail. So the current consensus estimate is that 40% of JD's food delivery users now also shop on JD's main site. And in April, JD actually saw monthly or daily active users growth of plus 18% and 27% year on year, the strongest amongst all these platforms. But for tier 2 success, which is them trying to overtake Meituan's dominance, I think for now, there is not so much visibility, and the trajectory that they're going, at least based on the growth rates and scalability, they are nowhere close. And in the longer term, I think they did make some sort of a prediction. They do expect a 3-player equilibrium in this food delivery space to persist. JD would stand roughly around 10 to 20%. Alibaba is roughly at 20%, while Meituan is roughly at 2/3. So when to put things into perspective, I think this current delivery war is absolutely insane, at least from a shareholder perspective. We are seeing very crazy top-line growth rates in terms of gross order volume, GMV, number of daily orders, so on and so forth. But I think from a shareholder perspective, it's absolutely insane. And as Hao Hong puts it, most of the subsidies have gone to bubble tea orders. And such a surge in bubble tea orders has already crushed the order system of China's 300,000 bubble tea shop. By comparison, there are 8,000 Starbucks in China, and it has also crushed the price of bubble tea. So this is yet another example of Chinese involution, or what we call 内卷. And it's odd that platforms are doing this at a time when the government is calling for anti-involution. And here's my overall reflection as a shareholder of 2 of these 3 companies. I think it's quite clear that there is unsustainable economics in the short term, since all of them are focusing on market share, and with all guiding for declining margins or just outright losses. And the market is also pricing this in. And evidently, that's why they are experiencing 30-40% drop in the last 3 to 4 months. So this is not a zero-sum game yet, at least based on my own observation, because interestingly, I think all 3 platforms are growing in order volume to a very large extent, and not so much trying to steal from each other. But in a way, I think they're trying to create the pie bigger by training the habit of daily Chinese consumptions and increasing the adoption rate. And considering Meituan has everything to lose, they're still posing positive growth for now. I think the million-dollar question is who can retain all these users or demands post-subsidy with the new equilibrium, of course. So Alibaba's ecosystem synergy, I think it's quite underrated here. And of course, please do your own due diligence. I'm biased here. So they're trying to blend and create new markets towards planned convenience. And I'll talk more about that later. And we are also seeing them flex more of their leverage across different verticals, through financing, through products, and even services. And we all know deep down that this too shall end, but when and to what extent is the largest question here. So let's talk about each companies individually. So for JD.com, I think for those of you who have been following me, I'll reiterate again, I'm not hopeful or bullish on where they're going with this. Even though I know that some of you actually do love this name, given their relative valuations and their assets they've built out and their distribution network, of course. And yeah, I think no doubt that if you look at their numbers quantitatively, they look attractive. But I think taking the cue from Meituan, they didn't give two flying flamingos when JD went into food delivery, but they mounted a full-on offense when Alibaba came in. So you know who they're really afraid of. So JD also seems to be the weakest horse out of the three. I think if you look at execution and scale, JD grew from 0 to 25 million. I think it's pretty impressive. But when you compare to the other two players in the market as well, Meituan went from 70 to 120 million in just 6 months or so. And that's a growth of 50 million orders, and they're already the incumbent. And Alibaba went from 30 million daily orders to 80 million. JD's 25 million daily orders don't seem like such a big feat, despite the huge amount of subsidies that they are throwing out. And if you look at growth, I think JD's street guidance right now is expected to grow at 16% year on year. And I'll talk more about this growth rate in the next slide and why this 16% don't actually look very enticing or attractive. And lastly, if you look at the finances, in terms of cash and cash equivalent, JD.com currently has around 194 billion, Meituan has 180, and Alibaba has 428. And clearly, Alibaba is the biggest brother in the pack, so they do have the deepest pockets and the biggest amount of firepower. But putting them aside, I think when you just look at this food delivery arm, Meituan already has the experience, the scale, and despite the subsidies, they already have a proven business model and they're operating a lot more profitably compared to JD.com. And if I were to speculate, I think JD.com's finances would suffer in the following few quarters. And also an important point is that I'm not saying that buying JD today will not make you any money, because since it's already priced for so much downside. But I'm generally just not bullish about the business. Now, going back to the top line growth rate of JD.com in Q2 of this year, HSBC Research has recently published a report stating that they are expecting JD to announce their results in August with the expected revenue growth of 15% year on year. And amongst them, the retail business revenue is expected to grow by 16%, benefiting from the 618 shopping festival. But on that same note, due to the group's increased investment in food delivery services, they are expecting their net income to decline by 61%. So here's the funny thing. I think we are seeing very healthy signs of encouragement by seeing JD.com's daily active users to grow by over 30% year on year, and with this top line 15-16% growth. But I think if you to compare based on the last 10 to 11 quarters, in Q1 of this year, they were already growing at 15 to 16%. And given this stepped up in subsidies and this crazy acquisition of customers, or just trying to get more people more excited about the JD platform itself, so I'm not too sure how you're going to categorize this campaign. Actually, revenue growth rate in the grander scheme of things did not accelerate too much anyway, considering that it came from a relatively lower base as well, because in the previous year, in that same June quarter, they only grew 1.2%. And likewise, I think there are quite a lot of question marks. So where is the whole cross-sell ecosystem benefits that we're talking about? Because you're attracting a lot of new users and you're bringing in a lot of new traffic and you're expecting to sell them something else in your other platforms. I think we're not seeing that so-called acceleration in growth rate as much as we hope so. And we are also expecting further investments in Q3 of 2025 during the peak season, which then means that I think bottom line earnings, whether it's net income, operating income, there will be further decline or deterioration. And you're still going to sink in so much more capital into this delivery war, and to what end and for whose benefit. Now, moving on to the second company of this holy trinity on Meituan, I think let's also not kid ourselves. This is a direct attack on Meituan's core business model. And without a doubt, I think their short-term earnings and margins are definitely going to get hit hard. But to what end and how long, I think is the million-dollar question. And given what the market is trying to price in today, if you're really serious about the long term, is this an opportunity or a threat? So it really depends on the size of the market, which will determine their growth ahead and how long and how sustainable this growth will be, how competitive it becomes, and how much people are willing to pay, which determines the take rate, and it will almost translate to their margins. And if Meituan do come out of this victorious, I think we'll be able to retire the bear case that Meituan is just a fancy delivery app. I think JD.com, for those of you who have been following them closely on Chinese social media, they've been crying foul the past 2 quarters, calling out Meituan on a variety of issues. So you have things like business ethics and rider exclusivity, taking advantage of workers and declining riders' welfare, and also hygiene standards and the proliferation of all these so-called unregulated ghost kitchens. And to let you have a taster in terms of Meituan's adaptability in the very fierce marketplace today, this is just one of the example. So Meituan is actually building out a capital-intensive infrastructure initiative called Raccoon Canteen, and it's aiming to construct 1,200 delivery-only kitchen hubs across China within 3 years, targeting support for 10,000 plus merchants. So these are real physical sites, funded and built by Meituan, and it's not virtual kitchens or licensing programs. So each site actually houses multiple standardized 10-meter square stalls, pre-equipped with ventilation, electricity, surveillance, and live streaming systems. So all food prep is live streamed 24/7, ingredient sourcing is logged and made public, daily food safety diaries are required, and tamper-proof packaging is used. So consumers can access all of this in-app, and the model is a direct response to increasing concerns over unregulated ghost kitchens, recently highlighted by JD as a threat to food safety and platform credibility. And merchants in this program also gain access to Meituan's Kuailv supply chain network, connecting them to 200 plus major food brands for direct procurement. And because multiple merchants operate in the same physical space, Meituan can enable multi-brand combo orders. And also naturally to achieve this idea of scaled economics. And I think this is just one of the many initiatives into understanding Meituan's adaptability to competition in this case. And last but not least, let's talk about Alibaba. So what about them? I think on July 3rd, they recently announced a 12 billion Hong Kong dollar zero coupon exchangeable coupon due 2032. So the bonds are linked to one of their subsidiary called Ali Health, and this is just one of the many examples that Alibaba is leveraging on their financial strength and their brand reputation to raise easy or even cheap capital. And also, in terms of how Alibaba is competing, Taobao already has a full merchant base and supply chain from its core platform, so it focuses subsidy entirely on the consumer side. So ground-level business development teams are deployed city to city to onboard merchants and to scale volume, while delivery is handled by both in-house and partner networks. So rather than compete directly with Meituan's 30-minute delivery, Taobao actually offers scheduled delivery windows, sometimes next day, with lower fees and broader SKU variety. So this allows them to shift from just instant consumption to planned purchases, and blending e-commerce with fast delivery. And this is really one of those new ways to capture even more demand and consumption patterns of the Chinese consumer today. But that said, I think with this whole food delivery backdrop, let's also not forget to scope things into perspective, at least for Alibaba on the group level. Their whole local services group compared to the $236 billion of the entire group revenue. And if you want to compare in terms of size, this is not even 10%, but this is 100% of Meituan's core business. And it also explains why, at least over the last decade, Meituan has consistently outperformed Alibaba's Ele.me in this food delivery space. So even with this new entrant, I'm definitely still placing my bets on Meituan in this specific case. And just to rehash my entire view of these three companies, I'm not bullish on JD.com with many of the points that I've mentioned previously. I'm betting on Alibaba, not so much on their food delivery platform, but more so their e-commerce cloud and by translation, many of their AI developments. And lastly, the entire thesis and investment case for Meituan. We all know in the short term, at least in the next 2-3 quarters, things are going to look ugly. But I think the idea of investing for the long term is to really see the end game, and this whole subsidies war will just be a very short blip. In fact, I'll put it out there. When I was buying some of these Chinese tech companies, namely Tencent and Alibaba, I was buying them down when there was this whole Chinese tech regulation thing. I was not even scared of the regulators because I'm approaching this whole investment case in the longer term. And I think those are temporary issues. And likewise, when looking at the subsidies war today, I think those are also temporary issues. I think the bigger concern for existing or even prospective investors is, are you bullish of Meituan's endgame out into the next 5 to 10 years? And just to give you a bit of flavor in terms of what GPT has to say, And do realize that this is my own personal GPT, so I might have influenced their own thinking and how they look at some of these companies. But from a portfolio perspective, in the short term, clearly, to avoid direct exposure to these names solely for their delivery businesses, because none of them are in a rational pricing mode. But in the medium term, do monitor things like subsidy tapering, user retention, break-even guidance to assess long-term durability. And for the long term, I think they favor platforms with ecosystem leverage like Alibaba and operational maturity like Meituan. And if forced to allocate today, they are more overweight for its balanced ecosystem-led expansion, which is Alibaba, whole or neutral because they are dominant but under near-term pressure for Meituan, and underweight JD until it proves delivery can be break-even without bleeding core profits. So take this with a pinch of salt, but I do share quite a similar perspective with this summary. With that in mind, I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.